The headlines today are more than noise, they're milestones. In Europe, Switzerland's SIX exchange has approved a new XRP ETP, giving institutions a physically backed, exchange-traded avenue to gain exposure to XRP without touching spot exchanges. In Chicago's derivatives arena, CME Group now shows over $1 billion in open interest tied to XRP futures, a figure reached in barely a few months. One of the fastest ramps we've seen for a major crypto listing. And in Washington, SEC Chair Paul Atkins is on record. Building a clear crypto framework is a priority, and it's a new day at the Commission. Taken together, these developments point in one direction. Market structure is maturing around XRP. This isn't about a single pump or narrative. It's about rails, regulated products, compliant venues, policy clarity, and institutional-grade liquidity being laid down in parallel across continents. Let's unpack it. Exchange-traded products are the preferred vehicle for a large class of European investors who want custodied, audited, and exchange-settled crypto exposure. With SIX approving a physically backed XRP ETP from a top-tier issuer roster that includes names like Bitwise on other crypto products, portfolio managers can route capital through familiar pipes, the same brokers, OMS/EMS, and settlement rails they already use for equities and bonds. Why this matters? Institutional accessibility. Many EU mandates restrict direct, spot exchange usage. ETPs solve policy and operational hurdles. Price discovery plus liquidity. As EUM grows, primary/secondary market activity tightens spreads and deepens the order book, improving the quality of exposure. Benchmarking and asset allocation. ETPs allow XRP to be slotted into multi-asset portfolios under risk models and compliance regimes already in place. In short, the Swiss approval isn't just a headline. It's a bridge from crypto-native trading to institutional allocation at scale. Reaching $1 billion plus in open interest this quickly is notable even by crypto standards. Open interest is commitment capital, funds locked into positions that form the backbone of market depth. For XRP, the implications are significant. Risk management, with futures, basis trades, delta hedging, and volatility strategies unlocked for sophisticated desks. Signal to compliance. CME is the venue of choice for traditional finance. Activity, there's a tacit green light for more institutions to request approvals internally. Tighter liquidity flywheel. Derivatives and spot inform each other. As OI grows, more liquidity providers step in, spreads compress, and execution quality improves. Add the ETP and the futures together, and you get a two-engine airplane. Listed exposure in Europe plus listed derivatives in the US. That's how global asset classes are built. The latest US unemployment print came in worse than expected. Bearish for risk in the immediate term, but bullish for rate cut probabilities. Markets sold first, then began repricing toward accommodation. For crypto, and XRP in particular, that means short-term chop. Weak labor data can spook risk temporarily. Medium-term tailwind. If the Fed pivots or accelerates cuts, liquidity conditions improve, historically supportive for Bitcoin large-cap alt utility tokens. Narrative convergence. Lower rates plus regulatory clarity plus listed products equals capital flows. September isn't typically a kind month for crypto seasonality, and yet structural signals, ETPs, futures OI, and policy tone are pulling in the opposite direction. Expect two-way volatility while the macro settles. SEC Chair Paul Atkins signaling that crypto market structure is a top priority matters more than any single enforcement headline. Multiple prongs are aligning. Framework first. Moving from ambiguity to codified rules unlocks compliance comfort for pensions, insurers, and banks. Coordination. The SEC's posture, combined with broader regulatory discussions, suggests a pathway for spot listings under surveillance and transparency standards. Green boxes for risk committees. When the rules are written, risk turns calculable, and that's when the larger checks get signed. No one should expect an overnight transformation, but policy posture often changes before flows do. and flows follow posture. Eric Trump saying crypto may go parabolic is the kind of headline that rockets across feeds. As traders, we file it under attention, not allocation. Political soundbites can prime sentiment without providing investable signal. Use discretion. Good news is not equal to good entry. When officials or influencers say up only, it often coincides with liquidity hunts and stop runs. Watch the tape, not the takes, price, volume, funding, basis, OI, and exchange balances will tell you what's actually happening. When mainstream European broadcasters describe Ripple and XRP as one of the most important and established pieces in international payments, that's more than flattery. It's mind-share capture, the public narrative catching up to a decade of build-out in cross-border settlement, FX, and on-demand liquidity. Public awareness greases adoption wheels inside banks and fintechs. Nobody wants to be the last mover. Even with bullish structure, ETPs, $1 billion OI, positive policy tone, XRP can churn. Here's why that's healthy. Distribution/accumulation. Large players build positions quietly during macro noise. Derivative overhang. As OI rises, gamma pockets and liquidation bands create sharp but contained moves. Event clustering. With rate decisions and regulatory milestones ahead, traders often fade rallies and buy dips while waiting for confirmation. Takeaway: don't confuse short-term reluctance with long-term weakness. Structure then price. This is not financial advice, just a framework used by many professionals. Core versus tactical. Keep a core position custody secure. ETP for mandates, self-custody for spot, and a tactical sleeve for event-driven trades. Levels, not lines. Expect battles around round numbers and prior highs. Manage risk with wide stops or options overlays if available. Data over drama. Track CME basis, funding, 6 ETP flows, exchange balances, and on-chain whale activity. Calendar risk. Mark labor prints, CPI/PCE, central bank meetings, and policy hearings. Big moves tend to cluster around them. Crypto has had false dawns. What distinguishes this cycle for XRP is the institutional scaffolding emerging in parallel. Listed access, EU6 XRP ETP, lets allocators scale exposure under EU-friendly rules. Derivatives depth, US CME OI greater than $1 billion brings professional liquidity, hedging, and better price discovery. Policy posture, US the SEC chair's tone suggests rules are coming, not just litigation. Real-world fit, in a liquid FX corridors, XRP as a bridge reduces friction and cost. A business case, not a meme. Media legitimacy. European broadcasters framing Ripple/XRP as core payments infra-nudges banks from pilot to production. When access, liquidity, policy, and utility align, capital doesn't trickle, it reallocates. Switzerland's XRP ETP approval and CME's $1 billion plus OI are not hype artifacts. They're infrastructure checkpoints. Add a friendlier SEC stance, macro wins that may soon blow in crypto's favor, and growing mainstream recognition of Ripple/XRP's payments role, and the path forward becomes clearer, even if the tape is choppy in the short run. Stay disciplined. Separate signals, ETP flows, OI trends, policy language from noise, partisan one-liners, influencer theatrics. Build your plan around custody, risk limits, and event calendars. And remember, markets price the future gradually, then suddenly. If this breakdown helped, tap like, share it with a fellow XRP holder, and drop a comment. Which matters more to you? 6 ETP approval or CME's $1 billion OI milestone? And why? I'll pin the sharpest take for everyone to learn from.